Imagine this. You borrow 100 rupees, then you borrow 200 rupees more, then 300 rupees to pay back the first 100 rupees. That's not growth. That's panic. Now imagine a country doing this, not a small one. The world's second largest economy, China. Today, China's total debt is 336% of its entire economy. That means for every 100 rupees China earns, it owes 336 rupees. Most people think this is fine. They say, China is rich. They control everything. They'll figure it out. But here's the scary part. Most financial crises don't start loud. They start quiet. And 2026 might be the year this debt bomb stops ticking and starts exploding. Let's rewind. For 30 years, China grew like a rocket. Factories, highways, skyscrapers, new cities every year. How? Debt. Think of debt like fuel. A little fuel helps you go fast. Too much fuel sets the engine on fire. China used debt to grow faster than any country ever. Banks lent money. Companies borrowed it. Local governments spent it. Everyone believed prices would always go up. Especially one thing: property. Homes weren't for living. They were for investing. People bought apartments they never planned to enter. Developers borrowed billions to build cities with no people. This worked until it didn't. Here's the problem. Most of China's debt is bad debt, not innovation debt, not productivity debt. But please don't collapse debt. Property developers can't pay banks. Banks hide losses. Local governments borrow more to pretend nothing is wrong. This is called rolling the debt. Evergrande, Country Garden, Sunak. These weren't small companies. They were giants, and they failed. Quietly. No dramatic collapse, just silence. China didn't bail them out fully, because it can't afford to. At the same time, China's population is shrinking. Workers are aging. Exports are slowing. Foreign investors are pulling money out. So now China has more debt, less growth, fewer workers, and less trust. That's a dangerous mix. So why does 2026 matter? Because debt has deadlines. Over the next 2 years, China must refinance trillions of dollars in loans. That means old debt needs new money. But here's the trap. If China prints money, then currency falls. If it raises taxes, then growth slows. If it cuts spending, then unemployment rises. If it bails everyone out, then inflation spikes. Every option hurts. Now zoom out. China is connected to everything. Your phone, your clothes, your car, your stock market. If China slows sharply, global demand falls. Commodity prices crash. Supply chains break. Markets panic. This isn't a China problem. This is a global shockwave. And markets hate uncertainty more than bad news. So, will China collapse tomorrow? No. This isn't a movie explosion. It's slower, messier, more dangerous. A long grind. Lower growth, hidden losses, sudden scares. 2026 isn't about one event. It's about when the system runs out of room. The real lesson: debt can buy time, but it can't buy reality. And when reality arrives, it sends the bill to everyone. If you want more videos that explain complex global stories in simple words, like this video, subscribe, and tell me what topic you want broken down next. Because the biggest risks are always the ones people stop talking about.